So I've been working in the investment business with Fidelity for most of my working life. I started as an analyst, but I've been running money, investing in the region, the broader Pacific region now for over 20 years. Obviously, China has been a key part of that, and I've been running a purely China focused fund, Fidelity China Special Situations, for coming up on 10 years. As for many funds, our main objective is to beat the benchmark. So our benchmark for the fund is MSCI China. The goal is to handily beat that. Um, the way we do that, I'm sure we'll talk about, but we want to try to give our investors as broad a possible exposure to the best opportunities that are out there in China. So we really try to spread the net as wide as possible in looking for the best ideas. We look across all the market caps. We also, unlike many other funds, invest in private companies. As you'll be aware, many companies are coming to market later these days. So a lot of the best opportunities are in the private space. We look to leverage our significant resources to capitalize on those opportunities as well. We have a really strong team. We've got over 30 dedicated analysts on China, looking across both public and private opportunities. So we're pretty confident we can find the best opportunities in the market and stay on top of those stories. The fund has pretty handily beat its benchmarks over the short and long term. As you'll know, it's been a relatively tough time in markets in China in the short term. The market's definitely out of favor. So if you look at that 1 year number, the fund is down around 10%. Again, ahead of the benchmark, which is down around 16. But as we look to more longer term performance, we start to see better absolute numbers. So again, looking over a 5 year period, we're just under 4% annualized returns versus a benchmark which is down around 3%. And again, as I've said, if we look further back, to a 10 year period, we're close to 9% returns. So clearly, we're going through a relatively weak period in the China markets, but the hope is longer term, as sentiment improves, we can revert back to those sort of better long term performance numbers. Sure. So, as we've discussed, we really look across all the market caps, in the search for the best opportunities. Um, as a result of that, we do have, I guess, somewhat of a bias to some of the smaller cap companies versus the benchmark. The thinking there is, as companies are smaller, there's less information. With less information comes more mispricing, and we want to own mispriced and undervalued companies. The downside to that is in weak markets, there's often less liquidity, and that can hurt the small cap companies more than the large cap companies in weaker markets. Obviously, in more normal markets, I think that value is reflected as long as the performance of the company is there. But in weaker markets, that can be a drag. As can gearing. We've got relatively high gearing now in the portfolio, around 125%, and that reflects the opportunities that we're seeing in the market. We really want to capitalize on those opportunities, but obviously in weak markets, that can be somewhat of a drag on performance. Fortunately, we've been able to offset these negative factors, through the weak markets with better stock picking. But the hope is that in the longer term, as markets normalize, that will be less of a drag and can actually contribute, to performance over the long term.